Price action is the core foundation of any trading strategy. In this video today, I'm going to reveal to you 5 secret price action patterns that every trader needs to know in order to have an edge in the market. These are the most important patterns in the financial market, and it will help you to develop a day trading strategy with a high probability of success. These patterns are happening all of the time. These patterns affect everyone, whether they know it or not. These patterns are observable on every single time frame. They give you an exact trading plan that never changes. 90% of traders lose their money because they do not understand these patterns. This is the system of the market makers who drive and move the markets. The key to understanding the flow of money is understanding the movement of liquidity. And the way the markets move is that price always flows from liquidity to liquidity. Let me show you exactly how to mark up these secret patterns on your chart. These are the 5 patterns I'm going to be showing you. Number 1, supply and demand zones, contraction boxes, contraction lines, expansion lines, and liquidity lines. If you have a quick look at this diagram, we'll go into detail exactly about these patterns. Once you understand how these patterns work, it's kind of like a scaffolding that you create. It's a structure that you create within the market that helps you understand the flow of money and where's the best places to be entering the market and exiting the market. These are the core foundation here. So you can see, number 1, we've got demand zones, and demand zones are created by breaks in structures and momentum displacement in the market. We've got contraction boxes, we've got contraction lines, expansion lines, and liquidity lines. These are all the aspects that show you about how liquidity moves, how money moves in the market. So number 1, we've got supply and demand zones. This is a very important one, and you'll often notice the market respects these levels. So whenever we get a big movement of displacements where demand is increasing in the market, it leaves behind an indecision candle. This indecision candle, which is the last bearish candle before the bullish move, we mark out, and that becomes our demand zone. And on the opposite side, once we've got this bearish displacement to the downside and we left behind an indecision candle, we mark that indecision candle out, and it's usually the last bullish candle before the bearish move to the downside. These zones usually occur where we get big market movement taking place. Here's an example of the bearish order blocks. So as you can see, we got these big breaks in structures to the downside, break in structure to the downside. Whenever we get this massive movement to the downside with breaks in structures, it leaves behind these indecision candles. We mark these out, and as you can see in this example, price comes back and respects these zones. I definitely recommend, after watching this video, back test everything I'm showing you and test it out on your charts. And for a bullish example, you can see we've got breaking structures to the upside, also known as chocks or change of character. This is just showing you different market structure breaks, and you can see it leaves behind an order block zone. We mark out that zone, and price comes back, taps into that zone exactly before it moves in the opposite direction. So these become liquidity levels where there's pending orders resting. The secret to how these work is understanding indecision candles. Whenever I'm marking out order blocks, I'm always looking for indecision candles. And this is a great order block trading strategy. I would mainly use indecision candles on higher time frames. So an indecision candle is when we've got a small body with big wick on either side. And these are actually contraction zones on the higher time frame. Here's different kinds of indecision candles, so they can look various different styles. Usually, indecision candles are also inside bars, and they represent the stage in the market where the buyers and the sellers become equal. They become balanced. This is often a place where there's strength about to occur or weakness about to occur in the market. Here's an example. So you can see we get these big breaks in structures to the downside, big momentum candles. And you can see we got this perfect indecision candle we mark out, and this becomes our zone where we wait for price to come into, and we observe how is it going to react off this zone. These zones usually have a high probability of price reacting off of them. Here's a bearish example. So you can see big displacement, break in structures, and then we mark out that zone. Here is a bullish example. So you can see over here, we get a bullish break in structure, change of character occurring, and then we mark out that indecision candle, and that becomes our demand zone. The best order blocks are always accompanied by displacement of price. And displacement pattern usually represents these big momentum candles either to the downside or to the upside. This is showing us that there's volume, there's big orders and transactions taking place at these levels. Here's a fantastic breakdown of a structure of multiple aspects of these patterns working. So you can see we've got contraction box over there, which I'll go into in a moment, and we've got value lines, and you can see we've marked out our order blocks. And it's amazing to see how price absolutely respects these levels. You can see we've got contraction, then we've got expansion, and then price goes into the trending phase, taps into the zones where we get these reactions. So number 2, contraction boxes. Contraction boxes is something that's super simple to actually calculate on your chart. All you have to do is you wait for price to create a simultaneous lower high and a higher low. So you can see over here, we got a lower high and a higher low. When we get that happening on the charts, it's showing us that a squeeze is happening. It is showing us that is an inside bar formation taking place, and contraction is a very important aspect to become aware of on your chart. So you can see contraction represents this funneling in and then funneling out, because contraction and expansion usually work side to side. Contraction is the breathing out and expansion is the breathing in. So you can see we get this funneling getting tighter, 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 forming a contraction box, and then it expands outward with momentum and volatility. This is the contraction expansion cycle. Then we get contraction lines. Contraction lines are formed when we get the expansion out of the contraction box. So you can see price goes into contraction, forms the box. As price breaks out of that box, that's where we get a formation of the contraction line, which also turns into the expansion line, which I'll get into in a moment. These contraction lines become extremely valid friction levels, support and resistance levels, and price often respects them. You can see over here, price squeezes, gets tighter, tighter, and then it forms contraction box. This is where the buyers and the sellers become neutralized, and then price expands out of the box. And then as it expands out, it forms this contraction line. Price will oftentimes respect these levels. They will either serve as very strong support and resistance levels. Then we get these expansion lines. Expansion lines is what happens when we get a confirmed contraction line. So as price expands out of the box and breaks above the line in the box again, you can see if we get a break below and a break above, then this line turns into an expansion line. It is confirming to us now that the expansion phase has started. The expansion phase is a very important phase to become aware of, because it lets you know where the manipulation is going to start and where the incoming volatility is going to begin. It creates this whipsaw movement around the value lines. This whipsaw movement is designed to manipulate and liquidate the retailer who don't understand what is going on. That is why it's super important for you to understand this process. Understanding the difference between the contraction and the expansion lines will give you an understanding of how this methodology works. So you can see contraction lines are formed when price breaks out of one side of the box. And this usually forms a one-legged breakout expansion. Price can usually just expand onto one side. How expansion lines are different is that price breaks out the top of the box and below the box, starting to form this whipsaw formation when it breaks above and below, above and below. And that is the key feature, and understanding the difference between these two aspects. And then number 5, we've got liquidity lines. Each time price breaks out of the contraction box, it creates this whipsaw funneling out motion. And the further it gets from the box, the bigger the swings become. At each point, they form liquidity lines, and then each liquidity line gets taken out. These liquidity lines are letting us know where the stop loss levels are located of the retailers. These stop loss levels act as important liquidity pools to give you information about where could be the best place to enter your trades or exit your trades, because you know where the liquidity is resting. When we're trading, we always want to pay attention to where is the liquidity. What you do, you can always become aware of these liquidity levels. You can mark them up on your chart, and then usually when price hits a major liquidity level, we often get a reversal or reaction occur at those levels. So we can use those levels at excellent places to either exit our trades or to enter our trades. Here's a framework of all of these criteria and aspects together. So you can see we've got the contraction box, and the contraction box can also form an order block or supply and demand zone. At the bottom here, you can see we've got our contraction box, and then price whipsaws out of the box around the value line. This value line or expansion line, it acts as a key determining factor of where true value exists on the chart. You always want to look to only enter your buy positions underneath the expansion line, and your sell positions above the value line. But this is all dependent on the direction of the trend and the bias of the market. So let us go to the charts and I'll give you a quick understanding of how this cycle works. We're on the charts right now, and if you look at this diagram I created, it'll give you a deeper understanding of how this works. So you can see price squeezes, goes into contraction, and we get the contraction box formed. This is where you get a simultaneous higher low and lower high forming. This is phase number 1 in the market cycle. We have 3 phases in a market cycle. And then as price breaks out of the box, it is the start of the second phase, which is the expansion phase. So phase number 1 is a leading phase. It lets you know what is going to happen next. And then we know incoming volatility is going to come into phase 2. Phase 2 is also the manipulation phase. It's where we get this expansion above value, above value, and below value. This is designed to manipulate and liquidate the retailer, but if you understand this process, you can take advantage of it. Once this expansion happens in this whipsaw, we're looking for long entries underneath the value lines and our short entries above the value lines. But this is all dependent on the bias of the market. If on the higher time frame it's in an uptrend, then you're only looking to enter your longs when price is underneath these value lines. And then we get phase number 3, which is the trend phase. Usually when price breaks out of the contraction box, we get a whipsaw above, below 3 to 7 times before it goes into the trend phase. Once it goes into a trend phase, this is a deviation away from value, and then price is breaking away with momentum and strength. This is the profit taking phase. So we get these 3 phases that are occurring over and over again. Doesn't matter what chart you're looking at, whether it's crypto, forex, indices, it plays over and over again. Once we understand this important pattern, gives you an edge in the market because you will start to see how price respects these levels. Let's have a look at a chart right now. This is TAO USDT. This is a cryptocurrency coin. And I just want to show you how price respects these levels. I've now added the indicator onto the chart, so we have a trading view price action indicator called indicator X that actually marks these levels onto your chart. As you can see over here, we got the contraction boxes, we got the value lines, and we've got the liquidity lines. The only thing it doesn't mark on your chart is order blocks, but it's very easy to learn order blocks, and in our group we teach exactly how to use order blocks. We have a lot of trainings for that kind of thing. If you are interested in this kind of trading strategies and understanding price action, we have a private Discord group where we offer live trading every single day, weekly live training. We offer live trade setups, helping you find the best tokens to trade every single week, providing you with trading tools, indicators. We also have a first of its kind top coin scanner that helps you scan the market and find the best tokens to trade. If you're looking to join a trading group that will really help you understand price action and how to trade the market like a professional trader, consider checking out our group, checking out our indicators. Click on the link below, you'll find out more information about that. We're back on the chart, and this is a crypto coin called TAO USDT. But like I said before, guys, it doesn't matter whether you're trading crypto, forex, indices, stocks, it doesn't matter what it is. This price action indicator will work, and this strategy will work. Whether you're marking it up on the charts by hand, like I showed you within this training, or whether you're using an indicator, we've got a price action indicator called indicator X that marks this up on your chart for you. And what it does is it shows you contraction boxes, value lines, and liquidity lines. These are some of the most important patterns that you need to become aware of, and it really helps you to have an awareness of where this is marked up on your chart. In this example, I'm going to show you exactly how this 3-phase cycle works. So you can see we got the contraction phase starting over here. This lets you know that there's incoming volatility coming next. Then we've got the expansion phase or the whipsaw phase. Price will usually oscillate 4 to 7 times around this level before it takes off into the trend phase. So you can see here contraction phase, expansion phase, and trend phase. And then we can often look to take our profits when price hits these liquidity levels. So you can see over here when price gets underneath the chart, can you see here? Comes underneath here, hits, breaks this level. As soon as it hits a liquidity line, this is often the place where we see a reversal occur. Happens over here as well. Look at that. Hits liquidity, we get a massive reaction. Hits liquidity, gets a reaction. So how this works is we always want to look for our long positions when price is underneath meet the value lines, and primarily if it hits a liquidity line or we get reversal candles. We also have another indicator which helps us get more precision entries called the TDIX. There is a video on that as well. If you want to check that out, look at the link above and it'll take you to that video. But the key on how this concept works is as soon as you identify the direction of the market, if the market is in an uptrend, then whenever we get these master patterns formed or these contraction boxes and expansion lines, and we're only looking to enter when price is underneath these value lines. This gives you the best entries you will ever find entering into a trend and give you the safest place to enter that will put you in the least amount of risk and the least amount of emotional pain. You don't need the indicator to mark these on your chart. You can just follow the instructions that I've shared with you in this video, but understanding these 5 patterns will give you a very good understanding of how liquidity moves, how price moves from liquidity to liquidity, and it'll definitely give you a massive edge in your trading. If you are interested to find out more about this kind of trading or this strategy, or check out our group or have a look at our indicators, click in the link below to find out more. Thank you for watching this video and have an absolutely amazing day.